Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is Turd Ferguson of the TF Metals Report. Thank you for joining us here today, Turd.
Jason, it's my pleasure.
Thanks, Turd. And you're a gold and silver precious metal expert. You originally started off commenting on Zero Hedge, and you spun off the TF Metals Report. For our listeners who are not familiar with your work, I definitely think they should check you out.
Yes, thank you. I got involved in Zero Hedge back in kind of the early days of that site, I suppose, and I was inspired by a lot of folks there to start my own site because people were posting on there that they found themselves searching through all these threads trying to find my avatar with the big yellow hat, and they got tired of doing that, and they wanted to have kind of a central place where they could find whatever I was thinking about the metals, and so I started the site just kind of. I couldn't believe that people were really that interested in what I thought, and it has just caught fire ever since. That was almost 2 years ago, as a matter of fact, and it has become a rather surreal ride for the last 24 months.
That's great, and that's kind of similar story to how Wall Street for Main Street started. I mean, after I worked in financial services for like 6 or 7 months, got all my licenses, I was behind the curtain, behind the Wizard of Oz curtain that was pulling all the strings, and I heard, all the bad things that were going on, how to dupe your clients and how to get them into high commission products that you knew were garbage. And I quit, and I woke up, and I was like, whoa, the people of Main Street really need to figure things out after the market crash. I was just looking for answers, and then, I went and read all these books and documentaries on investing, and people were like, well, you should start your own website and start your own company because you really know what you're talking about.
Jason, I'll follow on to that. I was a stockbroker for about 7 years back in the early to mid-'90s, and was involved in that industry for about 10 years after that. And I agree with you completely, and that's one of the reasons why I've started this site, TF Metals Report, and taken the direction it is. We deal mainly with the metals and the miners and all of that, and it's because there is a complete lack of objective information in the traditional investment management world. You might, if you have an account with Merrill Lynch or Smith Barney or one of these places, you'd go in there and you'd sit and you'd say, I don't know, they're devaluing the dollar and all this debt. I think I should buy some gold. And first the stockbroker would laugh at them. And then maybe in the end patronize them by pulling out, some investment banking report that their analyst came up with that's, complete nonsense because it's, probably a company that they have a relationship with and they're making fees from. You can't trust those guys at all. And so, no, I hear you. There's a real lack of objective and honest information out there for people that are just trying to protect their assets or plan for retirement. So good for you. Yeah, keep doing what you're doing.
Exactly, Turd. And that's one of the main things that really pissed me off about working in the industry. And I still tried, after I worked at that one firm, I was still a newbie and I was still learning things. And I went and interviewed at other firms thinking that, this one firm was going to be different. And they were all basically the same. And, they just want really salespeople there. They don't want anyone with common sense, anyone that'll question the piece of paper that they're handed to sell the garbage. One guy was like, dude, you're going to question everything on the piece of paper that we try to sell to our clients, that we try to dump on them. He was like, I can't hire you.
Tells you right there what it's all about, that's for sure. You are, folks are just simply trying to work hard and save money, and you never really know what the other people's intentions are, that's for sure.
Exactly, and that's why when, Goldman Sachs issues like a conviction buy list on a stock, normally that means like the trading department wants to get out of their stock position and they want to dump it on their retail clients or dump it on the general public so they can start shorting it.
Yeah, and all the way down at the retail level, the broker that tells you that you've got to buy a certain mutual fund or a certain asset management product. May all sound good in the end, but you probably heard this adage, the firm made money and the broker made money, so 2 out of 3 isn't bad. That was always kind of the old joke.
Exactly, and that's the way the rent-seeking, the short-sightedness is now, is these are publicly traded companies, and, they're not run as partnerships anymore, and they don't really care about long-term customer relationships, really. So they're doing what they can to maximize every last cent of profit, I guess, in the short term, and they don't do what's best for their client as real fiduciaries now in the long term, and that's why I don't like the industry anymore.
Yep, I hear you. That's why I left as well.
Great. Okay, well, let's talk about the macroeconomic situation and your views of that before we get into the precious metal markets. Would you say that the world economy right now is kind of in a worsening stagflation, or do you see things differently?
No, I agree with you, and it has been that has been the case now for better part of, well, it depends on how you measure it, but better part of 4 or 5 years. There's this kind of Keynesian trick where the more money they print, it's having less and less effect. Or, the more debt that is issued, it has less and less growth on the other end. And we are at that end game now. And, the traditional Keynesian, educated, if you will, economists just don't seem to understand that. They think that we just need to print more money. The government needs to go deeper into debt to generate growth. And what they're not understanding is that $1 of debt does not equal $1 growth. I think it's now close to like $10 of debt equals $1 of growth, and it's just getting worse and worse. And it's an end game that the folks in charge, the ones with the PhDs, the ones advising the White House or the government or the central banks, it's just something that they don't understand, and sadly probably won't understand until it's all over and it blows up in their face.
Yeah, I agree with that. And the private sector is really not getting a chance to recover as much as it should. Now, the large firms who are connected to the government, who are connected to Wall Street and the Fed and can borrow cheap, they're doing pretty well. But a lot of Main Street is not doing very well, except for like social media and a few other sectors. And it's because they're being crowded out by the government borrowing, and because really the fundamentals of the economy, I mean, they're not allowed to, the wages aren't dropping. So if you're an entrepreneur or a small businessman and you have a good business idea, the wages for labor are not really dropping that much unless you're going to be creative and hire like a temp or an intern or a part-time person or something like that. And there's just too many rules, regulations, red tape, and taxes on small business to really create jobs in the real economy. And that's what we need to do if the politicians and the other people are really serious about fixing things.
You pretty well summed it up, Jason, and you throw in the confiscatory tax rates and the costs of all the other government regulations that have put on, not even withstanding the new health care laws that are coming online. And you're right, it's very, very challenging for the private sector, for private companies to grow and to hire. They're getting squeezed at the margin with input costs going up because of the ongoing devaluation of the dollar, and it's just a worsening cycle. And more of the same is not going to be, or even more of the same is not a solution. But unfortunately, that's the only route that we seem to be traveling down.
Yeah. So far, the Fed, to its credit, has been able, despite creating all this inflation, they've been able to manage the inflationary expectations and the velocity of money and just keep us in a lower level of stagflation. But what they've done, to use an analogy, is they just keep pouring gasoline on everything and hoping no one lights a match. Yeah,
that's a decent analogy. You're right. And, the way that inflation is measured now is, as you know, I'm sure, certainly different than it was 20 or 30 years ago. And so it just depends on how you choose to look at it. If you want to go by the CPI, which is manipulated and controlled primarily to control the cost of living adjustments for all of the entitlement programs, but also to create this illusion that inflation is low, so as to justify, at least for the investor, the rationale of buying a 3% treasury. Well, if inflation's only 2%, okay, then I'll buy a treasury at 3%. If inflation's really 10%, and the government's stating at 10%, nobody in their right mind is going to buy a bond at 3%. And so, they massage those numbers. They try to make you believe what they want you to believe. And that's why it's so important for people just to kind of keep their wits about them, to use their own senses and to use their own brains and to come to their own decisions rather than what is being spoon-fed them by the media and the government officials and the Fed officials.
I completely agree, and that's where websites like yours and mine come in, hopefully, and also Zero Hedge, which is another really good one that you and I, I'm sure, both look at a lot.
Yep.
Now, changing topics here, let's go to gold and silver. Gold and silver have been in a wide trading range. They had their really painful correction and consolidation phase over the last 12 to 18 months. And would you say then that gold and silver are still stuck in a trading range? Gold was in, what, a $50 or $60 trading range recently, and silver was in, what, a $2 or $3 trading range recently. How much longer do you see this continuing before we go one way or another?
Frankly, not much longer. If you want to go really far back, I get far back in time. We're talking 2 years. But quantitative easing program number 2, which was set to be about $600 billion in what they call asset purchases, but that's really just a money printing program. That $600 billion was spread out over about 7 months and lasted from November to into June of 2011. When that started, or when that was announced, the metals rallied pretty well for about 6 weeks. But then in early January of 2011, we're really ruthlessly beaten back lower in conjunction with some suddenly improving economic numbers. The employment rate in January of 2011 dropped by 0.4% out of the blue. This kind of sounds familiar, doesn't it? Manufacturing indices and other data that would show some growth suddenly showed up, and gold over a 3-week period of time, and silver as well, gave back all of the gains that they had made in the 6 weeks of happiness following the announcement of QE2. That allowed the cartel banks, the bullion banks, to reposition themselves from being extremely short into being a little more less short, a little more neutral. And then from there, at the dark hours of late January 2011, the markets took off. Silver rallied about 80 or 90% over the next 90 days while this cash was being printed. Gold rallied almost 50% over the next 7 months. We are at that point again. We are following the almost exact same cartel playbook. We have given back after the initial QE infinity euphoria. We've given back almost all of the gains that we saw from September 13th till October the 4th. Actually, all of the gains and then some. And now we're at that point again. All of a sudden, this happy economic news we've got is some hope, I guess, for some austerity, if you will, from a potential new president. And all of this is being gamed by the bullion banks to push prices lower. Unfortunately for them, they're about to reverse. Once silver finally does break out through 35 and 36, it will be headed back higher towards 44 and its old all-time highs. And gold, the pivotal number is 1,800, which is the top of that range that you mentioned, Jason. And once it is through there, it will charge quickly back to its old all-time highs and beyond. Of that, I absolutely no question that that's what's going to be happening.
And you think this could happen then as soon as after the presidential election, or do you think then that the time frame has been pushed back a little bit due to this recent correction here before the election?
No, I think, the election now is 2 weeks away. I would not be surprised to see a significant short squeeze start to develop as soon as later this week. We've got the FOMC is meeting today, and we'll be announcing the results and what they talked about at their meeting tomorrow. That could be the spark to set off a significant short squeeze, and it could catch a lot of momentum from there. What the banks have done is they issue all this naked short paper to the speculative buyers that came rushing in post QE to infinity, and it left them with a very large short position. And really all that's left that they can do is to try to scare people out and drive them back down, and then cover their shorts into that long liquidation. That's the process that they're going through now. And once that's behind us, all that speculative money that's now moving short and has been for the last week or so, they're the ones that are going to get squeezed, and then the thing will catch its own momentum. So sometime in the next week, things will base and turn, if not as soon as tomorrow. And then I expect a very strong remainder of the fourth quarter and a Really exciting 2013. Provided we survive December 21st, 2012. We'll have a really good 2013.
Yeah, the Mayan calendar reference. And I was looking at other people's research, and they noticed that in presidential years, the gold and silver price tends to not go up as much as it normally does in other years, and that the year after a presidential election, it tends to rebound a lot. Like, I think the last presidential election, I think gold and silver moved, after the election was over, it moved 22%, gold did the next year.
I guess it's the uncertainty of, what type of policies we're going to follow for the next 4 years that kind of leaves people wondering if it will continue, but it will continue. Regardless, I guess if Obama's reelected, people figure, well, hey, then it's just more of the same. And they fear a Romney election. But what power will Romney have? One, the situation is untenable. We're running $1.3 trillion a year in debt. There are no real buyers for treasuries anymore. That's why the Fed is printing almost $1 trillion a year in bond market support. Okay, so that we can, we're basically self-funding it from the Fed now. Even if there was the will of Obama or of Romney and Ryan to dramatically try to bring the budget in line, they don't have the votes to do it. They won't have a supermajority in the House. They won't have a supermajority in the Senate. All of that political stagnation is what we're going to see again in 2013. So it doesn't really matter what kind of platitudes and whatever it is that they say their plans are that might get them enough votes to get elected. When it's a practical matter of trying to make things happen and trying to address this debt, they're not going to be able to do it. The only solution is to continue to devalue the currency, print money to fund the government debt. And so in the end, it doesn't really matter who wins. And the market will soon realize that, and that'll be what really fuels an extraordinary rally in 2013.
Yeah, I agree. And to put solution in quotes, because, these politicians, like, they really, and you mentioned this earlier, they have exactly the same stance on a number of issues. You have Romney Care and Obamacare.
Yeah.
It's very, very similar. And, like, Romney does have a better private sector record, but he's also basically a crony capitalist, and he's tied to Wall Street and all those guys. So I don't see Main Street, I don't see small business, I don't see entrepreneurs, I don't see any beneficial things happening there in that regard, and I see the Fed, unfortunately, continuing to expand its balance sheet. I think they already pre-announced that starting in January when Operation Twist expires, since they don't have any more long-term treasuries they can really buy, that they're going to start buying more mortgage-backed securities and other things, and they already pre-announced what they're going to expand their balance sheet over $540 billion in 2013.
Yeah, it's going to end up being more than that. Yeah, it'll be back to, if Twist is $45 billion a month, and they're currently supplementing that with their own $40 billion that they're printing. Well, when Twist ends, they're just going to have to they're just going to have to replace that with an $45 billion additional in quantitative easing. And the interesting thing, Jason, if you do the math, that's $85 billion a month. If you go back and look at QE2, $600 billion over 7 months is about $85 billion a month. So we're right back to where we were in the amount of money that was printed in early 2011. And again, that's the exact same fundamental that will influence the metals markets once this current correction/pullback is over.
Yeah, I agree. And there's also record demand for physical bullion. You have all of these gold exports that the United States just came out and announced. I think, over 400 tons of gold were exported in 2011 to Asia, to London, and the other areas that are starting to demand more bullion.
Right, and so when we talk about fundamentals, that's even stronger by orders of magnitude than it was in 2011. At least in 2011, when QE2 was going on, there were still a significant the vast majority of investors and global investors and central banks out there still thought there was hope for fiat currency, still thought that there was, some logic behind what was going on and that it was going to play out. That majority has been trimmed, still not by a huge amount, but we're seeing now central bank buying. We're seeing huge sovereign fund buying. We're seeing huge individual investor buying, frankly, at every single London fix. people are showing up for allocation for metal to take delivery and exchange their devaluing and crumbling fiat currency for hard assets. I mean, you see it in the charts. I mean, we've had some pullback in euro gold, and we've had some pullback in gold price in Swiss francs, but still it's near its all-time high. And it's because any fiat currency is devaluing so quickly that there's this consistent rush, this consistent move, this consistent demand for physical assets. It was there in 2011. It's going to be even more significant in 2013. And as a fundamental, you combine that with the untenable situation for the fiscal situation, both in Europe and in the U.S., the metals are going higher. I mean, we can sit here and it gets really frustrating to watch day after day the specs and the HFT and the smaller banks try to run price down, the paper price down, the COMEX. But investors and people that are trying to protect themselves have to keep their eye on the bigger picture and not worry about what's happening today or tomorrow, and worry more instead about what's coming in the next couple of years. They just have to keep their eye on the ball and not get distracted.
Exactly. And what I try to do is when I'm buying bullion, and this is not gold royalty companies or mining stocks, but when I'm buying bullion, I take a long-term view, and I view buying bullion as really not an investment, just for insurance and wealth preservation. So I wait for dips for gold and silver. So a big smash today, I'll probably be going in and looking at buying some physical silver again on a big dip, and after today, and then if it goes down a little bit more, down to 30 or 29, then I might buy some more.
Absolutely. Sounds like a good strategy to me, Jason.
Okay, so I think we addressed the gold and silver, and I think we both outlined why it's going higher in our views, regardless of manipulation. I mean, I'm in the camp that it's a managed retreat by the manipulators, that they can only do all of this stuff in the short term, and they can only create massive paper price volatility to knock out the weak hands.
Well, and again, I've always said it's part of a larger scheme. I mean, the number one goal of the Fed and working with the Treasury Department and the U.S. government, the number one goal is to sell bonds. I mean, we have to make this whole cycle of U.S. dollars work, we have to be able to sell Treasury bonds. And since the size of that debt continues to grow, the overall debt, and with the size of now the annual deficits growing, it becomes more and more important to have rates be lower and lower and lower as you service that debt. Because we're currently paying almost $500 billion a year to service the debt, the accumulated debt in the U.S., and that's at an average coupon of under 4%. Well, crud, if it went to 8%, you'd be paying $1 trillion a year. And as those interest costs rise, it only accelerates this rapid spiral down and destruction of the current system. And so there is this vested interest in keeping rates low. Okay, well then what's gold's part in that? Gold as an alternative to fiat currency. Gold is money. It's been money for millennia. Gold must not be perceived as a real viable alternative, or at least not as an obvious alternative. So, I mean, if gold were screaming higher, $100, $200 a day, and if gold were $10,000 an ounce instead of $1,700, what would that tell you about the value of fiat currency? And if gold were screaming higher like that, since it's also perceived as an inflation hedge, people wouldn't buy this 2% CPI nonsense. They'd go, well, wait a second, how can CPI be 2% if gold is going up 150% a year? And it would just be another reason why no one would buy bonds, and they would demand a higher yield. And as I just said, a higher yield only accelerates the demise of the Ponzi. And so that is the rationale for precious metal manipulation by the Fed through their primary dealer banks and the bullion banks. That's why they do it. They are being overwhelmed. It's a managed ascent. It's a managed retreat, as you said. But even that is going to get overwhelmed in 2013, and it's going to be spectacular to watch.
Yeah, I would completely agree, and I would also like to add that I think the U.S. wants to, besides selling treasuries, they want to maintain that petrodollar system because it's very, very profitable, because the world's reserve currency and the petrodollar create artificial demand for dollars, and that forces all foreigners and foreign central banks to hold massive amounts of dollars in reserve to transact in dollars to buy commodities and especially oil and other things.
And think about what a scam it is. Gold is never discussed as a currency. It's discussed as a commodity. And so there was just an article, somebody emailed me this morning about the dollar being this safe haven. And you see it. I mean, the dollar's rallying today as the stock market's down 250 points.
Well, what do you, sorry to interrupt you, Turd, but what if you're calling the dollar safe haven? I mean, if you're comparing it to the Japanese yen or the euro, maybe it is in the short term as a safe haven because the U.S. can print more money and create more liquidity than the other guys, but that's not saying much about the dollar compared to all the other fiat currencies, which are also garbage.
Right, and as a safe haven for your devaluing the underlying devaluation of your purchasing power and everything else. And that's what's such a joke. That everybody looks at the U.S. dollar index. Well, what is that? It's the dollar compared to a basket of other paper money.
It's mostly just to the euro. Yeah, the dollar index is so misweighted. It's mostly just to the euro and the yen anyway. Yeah. If it was, I wrote an article on this a couple of years ago. If it was reweighted compared to the U.S.'s G20 trade partners, the dollar index is even more of a massive fall off cliff.
Right. But if you just look at it in its current construction, go pull up a 5-year chart. You see the dollar's about unchanged, and you look at it and go, oh, see the dollar, it's nice and stable. Well, it's stable compared to all these other piles of crap that are being printed nonstop by all these other central banks. But 5 years in relation versus gold, it's been devalued by more than half, but it's been devalued by 2/3. And that never, you're not going to find that.
And that's after losing more than 95% of its purchasing power since 1913. Right. So it lost another 50% alone just in the last, few years, like you said.
Yeah, good luck getting your stockbroker to have that discussion with you. Good luck finding that discussion on CNBC. It's just not going to be there. But if the listener of our conversation understands that and knows that intrinsically that's right, they need to take action themselves and protect themselves.
Exactly. Now, that's buying physical bullion for insurance and wealth preservation. But let's talk about the gold miners. And I'm looking here at the chart, a long-term chart of the GDX, and the chart seems to have put in a really solid double bottom. It seems to have touched twice right above 40, and it seems to be working its way towards a cup and then kind of forming the handle here because the volume has kind of dissipated. Do you think the miners, and they've had a really rough 18 to 24 months, do you expect a reversion to the mean, and do you expect the miners to outperform kind of like they did after QE2 announcement during that 2010, early 2011 phase where some of the miners literally went up over 400% in less than 12 months?
Yeah, and I kind of favor a basket view. I don't have the time nor the inclination to try to sort through all of the pepper, and pick out the fly poop, because investing in miners, in a sense, is kind of like the way it was, back when the internet was what it was, a dozen years ago, in that you could go through all the different .com companies and try to figure out which ones were going to be the best, and you might buy Amazon and Priceline at the same time you bought Toys.com and, that kind of crap. 90% of them didn't work. But your Amazon, your Priceline did, and the hard part was, finding, and miners are kind of like that, in that, if you get into the juniors and then the exploration companies, a lot of those companies are going to run out of cash, because it's such a cash intensive business to try to get that, find it and then start getting it out of the ground. And then some will, mortgage their futures, by investment banking contracts and trying to get cash to keep the boat afloat, and then they'll sell forward all their future production. It's really hard to do. And so, yes, I agree. I think that the day of the miner is still coming, but for my, personal portfolio where I have them is all in a mutual fund instead, and try to have a big basket of them, and just rather than hit the absolute home run, 500%, 1,000%, let's just see if we can't, have an overall trending move and have the miners make you some money. That's the way I prefer to do it, because otherwise it's just, you got to almost cross your fingers and hope that you're right to pick them individually.
Yeah, I've made 600% on a few of the stocks, but I've also lost, to be honest, I've lost 60 or 70% or more on a few juniors. So, I mean, I've learned my lesson. My portfolio is still up pretty big since I started this 4 years ago. I quadrupled my capital while I learned how to invest in these shares, but I spend a ridiculous amount of time doing research. For our listeners out there, I think the best companies that people can buy and hold if they don't want to do the GDX, GDXJ, SIL, or buy a gold stock mutual fund like John Hathaway's I combine names. John Hathaway's Tocqueville Gold Fund. I think the gold royalty and streaming models for gold and silver, like the Silver Wheatons and the Franco Nevadas, those things just have a ton of free cash flow. Wall Street really likes them, and they pay a dividend. And they're like owning basically a gold stock mutual fund through one company. So I think those are the way to go there. You could just park cash in there. It's safe. They have like 10 different gold streams that are all cash flowing, and I expect big dividends because they don't have to take on the risk of an individual miner trying to build a mine, say, in Argentina, and then all of a sudden the Argentinian government's like, oh, hey, you didn't pay your tax bill. We're just going to confiscate this mine.
Right. And again, that's definitely your area of expertise and not mine. I mean, I just feel that I understand why so many of them have been treated the way they have for the last couple of years, and I know we're at the end of that process, and I feel that the miners as a group are ready to go up, and that's about as far as I can go. Because I'm too busy looking at the futures and everything else that I do.
Okay, I respect that. In wrapping things up here, Turd, please tell our listeners about your work and your paid service. Don't you have a new paid newsletter subscription with Andrew Maguire and any other service that you're offering that our listeners may be interested in?
Yeah, we do a couple of things. The free site, just the main site where everybody hangs out, is TF for Turd Ferguson, tfmetallsreport.com. It's one word. I post something there usually every day, and it's a great community, and people. It's not like other online sites where people just blast away and criticize and yell at each other. Everybody works pretty hard to help each other out, and because we're all kind of in this together. I also have a subscription site where I do a podcast every day, about 20-minute kind of summary of what I've seen and what my thoughts are. That is one word of just Turd, T-U-R-D, turdtalksmetals.com. You mentioned my friend Andrew. One of the weird things about being Turd is I've gotten to know a lot of people around the world, and that I would never in a million years I would think would be in my cell phone or in my contacts list. So I try to parlay those relationships into spreading, additional insider, I guess, information, inside baseball information that most folks normally wouldn't be able to get their hands on. I know that 2 years ago I couldn't get my hands on, so I try to use the Turd notoriety that I have to give everybody else as much access as we can, because again, we're all in this together, and we've all got to kind of learn and help each other as much as we can. So anyway, those are the two main sites, and if people want to stop by and visit us, I think they'll like what they see.
Okay, great. I just want to thank you so much for your time here today, and hopefully we can have you on again soon.
Anytime, Jason. It's been my pleasure.